If you are planning to work and collect Social Security in 2026, you need to stop what you're doing and listen very closely. The numbers for 2026 are officially out, and for millions of Americans, these new rules are the difference between a comfortable retirement and a financial disaster. Right now, there is a massive penalty trap waiting for anyone who earns even $1 over the new limits. I'm talking about Social Security clawing back your checks, sending you surprise bills for $30, $40, or even $50,000 years after the fact. But here's the good news. There is a first-year loophole and a secret called the ARF that most people don't even know exists. In today's video, I'm going to give you the 2026 Social Security Survival Guide. We're going to break down the exact dollar amounts you can earn, the magic monthly rule that lets you start benefits even if you've already earned $1 million this year, and a brand new $6,000 tax break that could save your bottom line. By the end of this video, you will have a proven blueprint to work, earn, and keep every penny of your Social Security. Stick around because the last rule we'll discuss regarding what income actually counts is where most people make the mistake that ruins their retirement. Before we get into the working rules, let's look at the landscape. 2026 is a year of big shifts. We are seeing a 2.8% cost of living adjustment, or COLA. This means the average retired worker's benefit will jump from $2,015 to about $2,071 a month. But as many of you know, what the government gives with one hand, it often takes with the other. Medicare Part B premiums are expected to climb to $202.90 a month, which eats into that COLA. This is why working has become a necessity for many. In fact, nearly 27% of adults aged 65 to 74 are still in the workforce. But the Social Security Administration, or the SSA, doesn't make it easy. They have strict earnings tests for anyone who hasn't reached their full retirement age. If you are under that age, the SSA essentially considers you not fully retired if you earn too much. Now, if this sounds confusing, don't worry. I'm going to simplify the most complex parts of the system right now. If you find this valuable, hit that subscribe button because we track these changes every single week to keep your money safe. Let's get into the meat of the 2026 rules. There are 3 categories of workers in the eyes of the SSA. Category 1, you are under full retirement age for the entire year. In 2026, your annual earnings limit is $24,480. This is up from $23,400 in 2025. Here's how the penalty works. For every $2 you earn above that $24,480 limit, the SSA will withhold $1 from your benefits. Let's look at a real-world example to see how this hits your pocket. Suppose you earn $38,000 in 2026. You are $13,520 over the limit. The SSA will take half of that, $6,760, out of your Social Security checks. If your monthly check is $1,700, they won't just reduce it. They will stop your checks entirely for 4 months until that $6,760 is paid back. Category 2, the year you reach full retirement age. If you hit your FRA in 2026, the rules get much friendlier. Your limit nearly triples to $65,160, and the penalty drops. Instead of $1 for every $2 you earn, they only withhold $1 for every $3 you earn above that limit. Crucially, they only count the money you earned before the month you hit your birthday. Category 3. You are at or above full retirement age. The moment you hit that milestone, whether it's age 66 or 67, depending on your birth year, the handcuffs come off. You can earn $1 million a month, and the SSA will not touch a single penny of your benefit. Does this mean you should stop working? Not necessarily, because there is a loophole that lets you earn whatever you want in your first year of retirement. This is the part of the video that saves the most people. It's called the monthly earnings test, or the first year rule. Imagine you're a high-earning executive or a business owner. It's June 2026 and you've already earned $100,000 this year. You want to retire in July, but you're worried because you're already way over the $24,480 annual limit. Under the normal rule, you wouldn't get a single check for the rest of the year. But the SSA gives you a grace year. In your first year of receiving benefits, they can apply a monthly limit instead of an annual one. For 2026, that monthly limit is $2,040, which is just $24,480 divided by 12. If you earn $100,000 from January to June, but in July you retire and earn less than $2,040, the SSA will pay you your full benefit for July. They ignore everything you earned before you filed for benefits. This is huge. It allows you to transition into retirement without being penalized for the hard work you did earlier in the year. But remember, this is a one-time deal. You can't use the monthly test again in 2027. You'll be back on the annual limit. If this is making sense to you, drop a comment below and let me know which month you're planning to retire. It helps me know what kind of examples to use in future videos.
Now, let's talk about what the SSA actually considers earnings. This is where people get terrified for no reason. They think their 401k withdrawal or their pension is going to trigger a penalty. Let me be 100% clear. The SSA only cares about active income. What counts? 1, W-2 wages from a job. Net earnings from self-employment. Bonuses, commissions, and vacation pay. What does not count? And this is the list that will make you breathe easier. Pensions and annuities. IRA or 401k distributions. Investment income, dividends, and interest. Capital gains, like selling your house or stocks. Veterans benefits or government retirement benefits. You could literally withdraw $200,000 from your IRA and receive $50,000 in dividends, and the SSA will still pay you your full Social Security check as long as your wages stay under the limit. This is the key to a wealthy retirement. Focus on passive income while keeping your active wages strategically low.
I know what you're thinking. What if I have to work? Is that money the SSA takes just gone forever? Actually, no. And this is the most misunderstood part of Social Security. It's called the Adjusted Reduction Factor, or ARF. Think of it like a backdoor savings account. If the SSA withholds your checks because you earn too much, they aren't stealing that money. When you reach your full retirement age, the SSA looks back and says, hey, we withheld 12 months of checks from this person because they were working. They will then recalculate your monthly benefit upward to give you credit for those months you didn't get a check. Basically, you're unreducing your early retirement penalty. This adjustment is 100% automatic. You don't have to file a form. The computer does it for you. So if you work and lose benefits now, you are actually just forcing yourself to have a bigger check for the rest of your life, starting at age 67.
There is one more massive 2026 change we have to discuss, and it's a positive one. It's part of the legislation passed in July, often called the One Big Beautiful Bill. Starting in 2026, there is a new tax break for people aged 65 and older. This is a deduction of up to $6,000 on your taxable income for eligible taxpayers. If you are a single filer with a modified adjusted gross income under $75,000 or a married couple under $150,000, you can claim the full $6,000. This deduction is designed to help offset the taxes many people pay on their Social Security benefits. This is a temporary break that runs through 2028, and it's estimated to save millions of older Americans a significant amount of money. When you combine this tax break with the ARF and the monthly earnings test, you can see that the system can work for you, but only if you know how to navigate it.
So what should you do right now? First, be transparent. If you know you're going to go over the limit, don't wait for the SSA to find out through the IRS 3 years later. File a work report with your estimated earnings. It's better to have your check stopped now than to get a $30,000 bill later that you can't pay. Second, protect your family. Remember, if your earnings stop your check, they also stop the checks for your spouse or children who are collecting on your record. The only person safe from your earnings is an ex-spouse. Third, keep learning. Social Security is understaffed, and they often don't give you these pro tips when you're on the phone with them. If you found this guide helpful, please share it with one friend who is still working. You might just save them from a massive overpayment headache. Don't forget to like this video so the YouTube algorithm can show it to more retirees who need this help. And for a deep dive into the 5 other big changes coming in 2026, click the video on your screen right now. Thanks for watching, and I'll see you in the next one.